Hi, David. Welcome back to F.A.C.E.
Hey, good morning. Thanks, Dale. How are you?
Doing pretty good. Good time to have you here. We have some history happening here. Not just whether fiscal packages get done or not, but this U.S. election, and people are starting to talk about a blue wave. And as technicians, we believe that. A lot of us believe, I'm not sure I believe it anymore, that markets are discounting mechanisms because
Mm.
I've seen them be wrong, whatever they've been discounting. So we're starting off here with S&Ps. What are you thinking here, David? Double top, or is there a shot for another high going into the election?
So I mean, you hit on it, Dale. You have to remember that the markets, especially the equity markets, it's all about expectations and what's being priced in, and the collective investor psychology and where people are leaning. The fact that the S&P is where it is, which even with yesterday's pullback, I mean, we're in a rounding error away from all-time highs. It
Yeah,
shows you that the expectation has been overwhelmingly optimistic. In terms, and again, with any of the potential headwinds that we could lay out, a contested election, a president who would be less, pro business, and higher taxes and whatever that might include. I mean, none of that seems to be phasing the markets right here. Which, so again, as technicians, the goal is to evaluate the price itself and see what we can infer. You mentioned the dreaded D word, double top, and I don't disagree with that. I actually think it's not just the chart of the S&P that makes me think we have limited upside. It's an analysis of a lot of individual stocks. So the S&P looks a lot like the chart of Apple, which is kind of in a
yeah,
similar, very similar sort of pattern. Had a
it
big
looks
blowout high in
weaker.
September.
We didn't
Yeah, a
even
little a
have a
little
double
weaker, and,
top.
and didn't
Yeah,
get as near to the previous high. And the
right.
other thing about Apple, you were talking just a moment about the CMT. Like, if you know your candle patterns, there's engulfing patterns, a dark cloud cover. There are all these bearish candle patterns when Apple has tried to rally in a meaningful way.
Yeah,
And so it shows you that there's clearly resistance to a lot of further upside there. And then, again, you have charts like Netflix come to mind, which are, arguably like a triple top. I mean, as clear of a resistance level as I think you'll find right now, where,
right.
we hit a certain level in July and just there is absolutely no power pushing this, or buyers pushing this beyond 560, 570.
Google
Um,
has been one of the weakest issues. I'm following Fang and MAGA right now since I,
mm, yep.
check that out. And, it's the only one that if you go through those that got all the way down to their 200-day moving average before this recent
And
bounce.
undercut the low from back here, which is kind of
Yeah,
unusual too. So Alphabet, out of all of them, arguably the weakest. I don't think you're wrong
yeah,
there, Dale. And
yeah,
again, so if you think about technical analysis 101, the basic thing I coach people to ask is this chart in an uptrend or downtrend? And the way you do that is by looking at the highs and the lows and just looking at the price swings and seeing what pattern
yeah,
emerges. And I think from March to August to early September, you saw one pattern with
right.
Google, and now you've seen a lower low, and now we're establishing a lower high. So by definition, the stock's now in a downtrend. Now, the reality is it hasn't been that destructive. It's still not far off of 1700, but it's certainly leaning more negative than positive. And so I think when I'm looking at the S&P or all of these names, I see a lot of names that have appreciated. I see a lot of stocks that are, showing the signs of what tops usually look like, which is either lower highs or bearish divergences, showing,
Right.
higher highs, but weaker momentum. So you're seeing that in some stocks. And so I think, at this point, it says basically short term, we're pretty rich. The long term story, though, is on something like the S&P. As long as we remain above 3,200, this sort of
Yeah.
structural uptrend is still okay. So I think what my base case is, and if you look at the seasonal tendencies going into, in an election year going through the last 3 months of the year. We had a panel on Stock Charts TV yesterday on the presidential cycle, and Jeff Hirsch had some great charts showing this, which was basically October tends to be pretty weak, regardless, and then November and December, regardless of who wins, if it's a new president or a re-election and a sitting president, November, December, just the seasonal tendencies of strength tend to overwhelm any sort of negative implications of a new president or an old president. And so November, December tend to be pretty strong. And so my base case is we sort of get back to that 3,200, 3,250 level over the next couple of weeks, and then we resume an uptrend into year end.
Could it be, David, that people have such outsized gains in FANG and MAGA that they're rotating into things like oils? I've heard cyclicals, and if the capital gains tax would change under Biden, that they're going to the door for better tax treatment before that happens, and they're rotating into unloved areas. Are you seeing that?
So absolutely right. So the question is, if there is limited upside, what are you going to do? And so that means, number one, you'd think about taking profits, and we're at that time of the year when you think about year-end tax implications, and especially if you've had gains, which hopefully investors do, and a lot do, but just because the market itself has risen, so you have to kind of think about how to deal with that. That would naturally get things out of what's worked, because that's where you have your biggest gains that you can take that off. But it also, I think it also, you have to remember that the implications of some sort of tax change probably aren't going to be felt for a little while. So the big divergence between, if you think about a Trump presidency going forward or a Biden presidency, the big difference doesn't happen in 2020. The big difference would happen in 2021. And if you look back at, a second term reelected, incumbent president, market tends to do pretty well year one after the election. If it's a new president coming in for their first term, regardless of party, the market usually tends to be weaker. And especially with the policies that we're hearing, it would most likely be a weaker, year one for sure. That first 12 months usually is pretty relatively weak. So I think any sort of now it's more cosmetic. It's more, I think the year-end seasonal patterns, the tax implications, small cap, large cap, all of that, I think will tend to happen, related to the normal seasonal trends. I think next year is when you'll feel the dispersion between who's president and what that might mean, because that's when you start to really digest big changes and what that might mean for people. And I think that's when investors would start to get a little more negative, with a Biden presidency potentially.
Yields had a nice little pop a couple of weeks ago and then settled down, and now they're challenging the highs of last week. I'm wondering what groups, I actually think we could get back to the lows that we had in 2019, about 140 or so. We clear 90, that would take it there, right? 50 to 90, 130. What markets would be affected the most by a rise in yields? And if it's a steepening, will the market like it? Banks?
So, possibly?
Yeah.
It's a great question. And so I think, if you look at the long-term chart of the yield curve, and we'll see how quickly I can find a good long-term chart of this. The chart I was going to show you is we have a chart of the 2s and 10s spread and how that relates to recessionary periods. And essentially what you had here, give me a second.
Sure. Take your time.
It's right in here. But basically, if you look at long-term interest rates, where is it? Yeah, I'm not going to find it. If you look at it, right, that the shape of the curve, we sort of have this, flattening of the curve, and since then, potentially we start to widen out a little bit. And if you look, that usually indicates where recessionary risk is lower, and that tends to be a little more constructive. What's interesting is the way that the market has behaved relative to that flattening is a little unusual. I mean, because it's rallied in the face of a lot of potential headwinds like that. Steeper yield curve, you'd think would be good for something like financials.
Right.
The challenge I have with financials and energy, which are sort of the things that I would sort of normally start thinking about, is just the relative strength has been so challenged. So if you look at the chart of the XLF, this is the financial sector for the last 2 years. The underperformance of financials is not a coronavirus story. That's a story from a lot further back in this chart. I mean, it's been a multi-year stretch of underperformance. And the ratio I love to show is looking at the ratio of the XLF versus the XLK. And if you had a binary decision of, do I own financials or technology, I'm not seeing anything, even with anything we just talked about, that would compel me to lean into financials and away from something like tech. Now that could change if people start really taking profits on, tech names that have outperformed, if the work from home trade starts to unwind, if financials start to break out, which they really have just not been able to do. That could, the face of that could change. But again, it's still that's fighting against the history that we've seen for quite a while. That'd be a very different look. I think energy too. There's an argument for buying energy, but the argument can't be based on trend following or any sort of traditional technical approach. It has to be more of a valuation decision, as in, the market has gotten so bad, the relative strength has been so negative, you'd expect a mean reversion of that trade and go back. But I don't see anything on here yet telling me now's the time to be getting into it. What's interesting with the XLE though is you could be putting in a higher low. That would be the thing to look for here, as the tech sector, as the S&P is potentially making a lower high, the XLE could actually be making a higher low here, which would be an interesting reversion, I guess, of sorts, to have stronger energy and weaker S&P.
I heard an interesting narrative from a contemporary of mine who, the whole world's still pretty bearish oil because of, the green revolution and carbon and EVs and, Saudi Arabia trying to diversify. But his narrative was, in order to really seal the deal for the transition to green energy, triple digit oil would do it. And Biden's starting to cap, he wants to cap wells, which is going to, cut back on supplies. And, I find that kind of a compelling argument. I'm not saying that, one country is going to determine price spike in crude, but that would definitely have everyone again. I know there's plenty of people clamoring for changes because of climate change, but economic, what? People move when it's affecting their wallets. And if we started paying if we started paying $5-6 gas again here in California, that would move people towards definitely more green EVs, etc. So I just thought I'd share it with you. Before I interrupted you, you were going to show a dollar chart, I believe.
Yeah, so I was going to say a couple other themes. I think first one is thinking of, you mentioned with interest rates, and even if interest rates rise to the extent that you mentioned, which is absolutely possible, the rates are still relatively low relative to the long-term historical values.
How low? We haven't been this low since the Civil War.
So, right. I mean, and that's true. Yeah. And it's funny. My daughter is 12 and we're talking about opening a bank account, and she got, she's learning about interest and all of these things. She was all excited. She's like, all right, can we go to the bank and open an account? Because I'm really excited to earn interest. I'm like, well, don't get that excited because it's not really that helpful at the moment, but eventually it could. But so the reality is, even with rising rates, I think there is still a lot of opportunities where there's a lot more income possibility. And so this is where I think utilities, REITs, which, in general have been pretty beaten down. If you look at the XLU since the March low, it's really underperformed pretty consistently. But if you look since the September market peak, you see how the relative strength trend has totally changed. And that's one of those where, people get trapped into a market call and they forget to just look at what's working. So, stocks retesting all-time highs, you certainly shouldn't be working. It should be offense, consumer, tech, and all that. And again, those aren't bad, but utilities are starting to outperform. It's breaking out of a base, which is more that I can say for most sectors and most stocks out there. Breaking out.
And that's a kind of a defensive signal.
It's a defensive sector, but it shows you that even when the market's rallying, something like utilities can actually do okay, because again, it's not just a market call that is motivating people. It's also things like income and stability and all the things that something like utilities, low volatility. And so I think it's a really good time to be looking at this line on a lot of charts, which is the relative strength line of whatever stock, whatever ETF you're looking at, even commodities, and looking at it relative to the S&P and looking for things that are starting to outperform, especially in a choppy, uncertain market. I mean, I think the way to describe this market recently is uncertainty, and I don't see any signs that uncertainty is going to decrease between over the next month. It's going to increase given potentially contested election, a lot of unknowns. And so stable yields that are fairly consistent, you're looking at utilities and REITs and high income generating parts of the equity market. I wouldn't be surprised if they perform better than people would expect, even in a positive tape.
Yeah, that's a pearl, David, looking at different sectors' relative performance to the SPY.
Absolutely.
A big believer in relative strength and buying leadership and fading the weak sisters. So, yeah, besides utilities, what else are you seeing that is outperforming? Oh, let's do the dollar first. So
yeah,
go
of
ahead.
course. Yeah. So you mentioned the dollar, and the previous speaker with some great charts had showed. He was calling them a lot of flags on the like the euro chart, which is essentially the
Yeah.
inverse of the dollar index. And
Yes.
I think I absolutely would agree with that. This is how I look at the dollar, and the chart coming off of the March peak down to September was one really clearly defined trend, and that very much changed here in mid-September. And from there, I think we're in a transition from weaker dollar to stronger dollar. I think that's going to continue for a bit. And again, just from a pure Dow perspective, we now have a higher high. We've established a higher low. We've pulled back a little bit. And so I think 93 in the short term is sort of that, really key level to watch. But I think breaking above a trend line here, taking these swing highs would be really good. And I think that clears the way to 96.50 on the dollar index, which takes you back to this flag pattern from June. So overall, I think you're certainly seeing that rotation and further upside. It could mean, and again, in general, stronger dollar usually means small caps do better than they relative to large caps. That's not necessarily the longer term trend that we've seen. So that might be a different look. Something like small cap value performing better than other things would be a different read for sure. But that could be a result of this.
We're on the same page there. I do think that's a battleground up there. The area that you identified for the bear market in the dollar, but I don't think we could close much above 97. Otherwise, I think you're talking
and there you have
about
the 200-day. You have this,
Yeah.
and again, the market has memory in this area, which was really that the midpoint of this downtrend. I think there's a lot right about there, which I think is there a possibility the dollar could get even stronger? Of course, but I think it's much less likely than a move up to here. And again, that's a pretty big move from a change of trend for sure.
Okay, great. Any other sectors that are outperforming the SPY that you like?
Yeah. So when
go
you're
ahead,
thinking
Jim.
about,
Nice.
I'll show you the relative rotation graph. So this is looking at the 11 S&P sectors here, and they're rotating around the S&P. So basically, this is the S&P 500 right in the middle. This is looking at the last 5 trading days, and essentially further to the right means you're outperforming, further to the left means you're underperforming, and then the y-axis is sort of the momentum, sort of the rate of change of that. So things tend to rotate in this clockwise direction around the benchmark in the middle. And
Cool chart.
so what you've seen in the last week or so, utilities, as I mentioned, has been a strong performer. So even though it's coming down here, it's further to the right, which means it's been outperforming, and that's the trend that we saw in there. The other things that have been doing well on a relative basis: technology, consumer discretionary. You see how these are starting to rotate down, though, and what that could mean is sort of a change of character. What's emerging and rotating more positive is industrials. And sort of the way I've thought about sectors are you have sort of tech and consumer discretionary are sort of the two main sectors. Is obviously Amazon and everything in consumer, and in tech, Apple and Microsoft and others that have been strong relative performance for quite a while. Then you have sort of the second tier of strong performers, and those are industrials and materials. And those are two that are actually increasing in momentum, kind of heading in this direction. And I wouldn't be surprised if you see them continue to rotate and get stronger. Those are the sectors that sort of emerged for a while, and it felt like we were having a leadership rotation, and then they kind of pulled back as consumer and tech reemerged. But now that those are sort of overextended, they're sort of hitting more of a potential top, double tops, or whatever. You see things like industrials with the potential to rotate higher. What's interesting is this includes things like airlines, which yesterday were one of the strongest groups, all around. So again, that has to happen more than one day, but you could see industrials continue to do well.
Do you have a rule of thumb for rebalancing your portfolios at certain times, or valuations, or is there a good the right time to do that and the wrong time to do that?
The wrong time to do it is never. I mean,
Okay.
in the
All right.
the wrong answer is not to have a good strategy for it. Do I have a strategy? I do, and I would say that the most important thing is to have. I would argue, and again, I don't know anyone's individual situation, but broadly speaking, and to generalize, I think having a consistent time where you review, weightings and see when you need to rebalance is important. So for me, once a month is the time that I'm looking at things, and as a long-term investor, that's about right. But
Okay.
I would also argue, I think a lot of people get trapped into rebalancing as opposed to the benefits of trend following, right? So if something like industrials is working, if utilities are working, I want to be able to lean into those as much as I can. And things that aren't working, I want to lean away from those. And I think sometimes when people get trapped into more of a structure that prevents them from following the trends, I think that's where it can be a little bit counterproductive. So
Okay.
yeah, so for me, I have a trend following model. I'm looking at sectors and ETFs across styles and broad market ETFs, global ETFs, putting them in a big pile and just seeing overall what are the strongest trends, what are the weakest trends, and have ways to lean into the strongest trends and lean away from the weaker trends. And that overall has been a good strategy for me.
Okay. Anything else you wanted to share today, David?
No, I would say
Wrap it with.
for me, I think the big question mark is, as we're at our testing new highs, what are the characteristics of the market? We talked about potential lower highs. We talked about the concerns of bearish divergences that you see on some charts that have been making new highs. I would say the only thing we didn't talk about was maybe more of the breadth characteristics.
Okay.
So when you think about market breadth, that's really a measure of participation. So it tells you,
Right.
if the S&P is doing X, what are the breadth characteristics? What are the individual companies doing? And if you look at what happened here, this is the cumulative advanced decline lines for a number of different slices of the market. So this is common stocks only on the New York Stock Exchange. This is the S&P 500, number 2. Number 3 is the mid-cap index, and then the small-cap index at the bottom. And I put the horizontal lines on here so you can see that 2 of these broke to new highs in early October as the S&P was sort of reapproaching S&P 3600. And it was the S&P advanced decline line, which broke out, and it was the mid-cap index, which broke out. 2 of these actually did not, though, and it's the lower end of the cap tiers, which I would argue would be most important because it shows you that there's a broader participation. So the small cap advanced decline line has not broken out. It's sort of met resistance. The common stock only index has met resistance, hasn't broken out. So you didn't get the confirmation of everything kind of breaking out. So the challenge I have there is it's starting, and again, this is sort of what happens at market tops, is you get a lack of confirmation from breadth, where some things break out, but not everything. And it sort of suggests some internal weakness in there. The mid-cap advanced decline line is potentially breaking back down below that breakout level. So I think this is an important chart to watch to sort of see whether or not, if the S&P is going to move materially higher from here, these indexes would have to break out, because those are the stocks that would be propelling the market higher. What it's telling you is it's a relatively smaller number of mega cap, larger names that have been able to break out to push the market higher. That doesn't tend to be sustainable. It tends to be, more characteristic of the latter stages of an uptrend and not the earlier stages.
What a great presentation, buddy.
Thank you. I appreciate it. The last thing I would say is with sentiment, there's some extremes in particular. Just one final thought, if I can.
Yeah.
Put call ratio is a really important one to look at. This is the equity put call ratio. It's at extreme lows, and it's similar to what we saw in June and September. That's sort of my
FIX looks okay to me. If we
problem.
get through 2980, I wouldn't be short volatility right now.
That's absolutely right.
Yeah, you could learn a big lesson. David, you want to show your website, because people that have listened to you for the last 25 minutes or so now know that if they want to know more about what's happening internally in the markets, that you're a great resource. And,
Yeah, of course.
I learned gleaned some pearls from you today. And if people see the video later, how they can get a hold of you and follow you. I know it's D Keller CMT on Twitter. What about your website?
Yeah, absolutely. So, I mean, stockcharts.com are the charts that we've been using for the presentation here. And again, this is the homepage. It's a really good starting point. And especially if you dabble at all in equities or ETFs, we have a lot of really good ways to rank those. So we have a proprietary ranking system called the Stock Charts Technical Rating, where we score stocks based on a simple trend following model. But it's amazing how well it'll point you into the charts that are working and point you away from the charts that aren't working. And I would argue for individual investors, more often than not, that's the game, is identifying the trends and following the trends. And hopefully we give you some ways to do that. The other thing I would say is for my own work, when I'm talking about how to approach the market from a mental perspective and sort of the mental challenge of what you're doing, go to my website's marketmisbehavior.com. I have a free course called the Behavioral Investing course, which is called the 5 Modes of Mindful Investors. And over a 5-week period, I'll walk you through a set of steps to think about how you think as an investor, how you're making decisions, what information you're consuming, and maybe worth taking a step back as we near year end and thinking about how you approach your investment decisions.
It's all in our heads, David.
That's it's very true. Very true.
We produce our own movies in our heads. So, some of them are horror films, some of them are happily ever after, but we're the producer, aren't we? So, David, right. Thank you very much, my trading warrior brother, for coming in and sharing some real important points and around a potential inflection point in the market. I appreciate you, David. Thanks again for edifying the F.A.C.E community.
Absolutely, Dale. Be well. Stay safe. Talk to you soon, all right?
Okay. That's a wrap, everyone, for Turnaround Tuesday. Good hunting the rest of the day. We'll see everyone tomorrow. And remember, don't just count your relative strength sectors, count your blessings, and we'll talk to you tomorrow. Adios.